Companies are struggling to find candidates who can build dynamic financial models, conduct scenario planning, and provide forward looking guidance that supports strategic decision making. That's straight from a new Robert Half report. So, if you can learn this skill, even at a basic level, you are instantly more valuable. I have been creating financial models for the last 25 years, but if I had to start over from scratch, here's the exact plan I'd follow. No fluff, no Excel rabbit holes, just what actually works. Now, that Robert Half study, it says companies don't just want Excel skills anymore. They need people who can forecast, run scenarios, and actually guide strategy. And that's where you come in. Even being decent at a financial modeling can make you more hireable, more trusted, and way more valuable. So, here's my roadmap to go from zero to being a well versed financial modeler. Step one, the bedrock, the three statement model. If I had to start over, I wouldn't begin with DCFs, LBO, valuations, or flashy dashboards. I'd start with one thing, the three statement model: income statement, balance sheet, cash flow statement. Not because someone is going to hire you to build one from scratch, but because it's the best way to truly understand how financials work together. The three statement model is the foundation of all other financial models. That's because it helps you understand how any change, whether it's pricing strategy, hiring plans, or a drop in churn, how they flow through a business financially. For example, a drop in revenue. Let's say we drop 10% in revenue. That hits your gross profit, that hits your net income, that reduces retained earnings, that affects cash from operations, that might even squeeze your ability to pay off debt. One change, five ripple effects. That's the kind of thinking employers are desperate for. They don't need someone to format cells. They need someone who can say, if this happens, here's what it means. And when you build a three statement model, even a simple one, you start seeing these relationships. You stop thinking in silos and you start thinking in flows. The model trains you to see how financial decisions cascade across the business. It forces you to ask, if this input changes, where does it show up next? It also sharpens your judgment. Suddenly you notice when forecasts are too aggressive, when margins don't make sense, or when debt levels are pushing limits. You stop accepting numbers at face value and start questioning them with purpose. You're not learning to build spreadsheets. You're learning how money moves, how value is created or lost, and how risks show up in the financials. And no matter what area of finance you go into, banking, fp&a, investing, this is the core skill that helps you diagnose problems and spot opportunities. It's the best way to internalize the DNA of a business, far more than memorizing definitions or formulas. The point is not to build a model that looks impressive. The point is to build one that actually works, where a change in one place flows through the rest of the system. And here's the real win. Once you understand this, your confidence goes way up. You stop second guessing every formula. You stop relying on templates that you don't fully understand. You build from logic, from first principles, from clarity. And once you understand that core flow, the logic of how statements talk to each other, you're ready to deepen in. Now, to really understand the three statement model and really learn it, you need to address two things: the three hook method and the basic supporting schedules. We will unpack both because they're what turn your model from functional to reliable. So, the three hook method. Now that I've convinced you to start with the three statement model, here's what I do to begin. I'd start by understanding the three hooks. This is the method I use to teach hundreds of students inside my financial modeling course, and it's the first step to make your model actually work. I'll leave a link at the end of this video to a walkthrough that teaches this method in detail, and if you want to go deeper, I'll also include a link for the full course. But right now, let's break it down. What are the three hooks? They are the essential links that hold the three statements together as you build. They are what makes the balance sheet balance automatically while you model. This isn't post-processing. These are live connections you put in place at the very beginning. So, hook number one, net income into the cash flow statement. Let's use a real company to see this in action. We have here the income statement of Coca-Cola. On Coca-Cola income statement, we see net income of $10,649. You also see a separate line for income to non-controlling interests, an additional 18 million in this case. That gives us a total consolidated net income of 10,631. But for now, let's focus on 10,649. Now jump to the cash flow statement. Here's the cash flow statement. Right there at the top, we see the same net income of 10,649. That's the first hook. This number becomes the starting point of the cash flow statement. From here, we walk it down to actual ending cash by adjusting for non-cash items like depreciation, changes in working capital, and financing flows like dividends, for example, which we'll come back to in a moment, but save this number. This is where people often get tripped at. Net income doesn't mean cash. This part of the model is about reconciling profit to cash. In Coca-Cola's case, once all adjustments are made, we end up with an ending cash of 10,828. Save that number. Now let's jump to the balance sheet. Right at the beginning of the balance sheet, right at the top of the assets section, we see cash and cash equivalents of 10,828, which is exactly what we saw in the cash flow statement. That's your second hook. It means that whatever we had in the cash flow statement will flow straight to the balance sheet. This link makes your model dynamic. When the cash flow changes, so does the balance sheet automatically. In Excel, this formula simply pulls the bottom line cash from your cash flow tab and put it on the balance sheet. And once that's connected, you've got a living system. Your statements stay in sync as you build. Now, hook number three, the net income into the retained earnings. Now, let's complete the loop with the third hook, retained earnings. So we see here the balance sheet of Coca-Cola. In Coca-Cola's balance sheet, this account is called reinvested earnings. And if we look at the change from 2023 to 2024, we see it went from 73,782 to 76,054. So what explains that change? To find out, let's go to a section called Consolidated Statements of Share Owners' Equity. There we see the beginning balance, 73,782, and then we add the net income of 10,631, this time including the 18 from non-controlling interest, and then we subtract the dividends, 8,359. And that reconciles exactly to the ending balance of 76,054. Here's the key takeaway. Retained earnings is a stock account, a balance account. It accumulates over time. It doesn't reset. Each year's profit that isn't distributed gets added. The final hook shows how profit turns into long-term value. When a company earns money and doesn't distribute it, that money increases its equity. And that's how your model reflects value creation. Not just the movement of cash, but the accumulation of wealth on the balance sheet. These three hooks, net income to cash flow, cash to balance sheet, and net income to retained earnings, are the core structure of every model I build or teach. There will be more layers and variations, more logic, more nuance, but if you get these three right, you'll be building a model that mirrors the real business actually function, just like we saw with Coca-Cola. And that's the kind of model employers notice because it tells a story and it's always adding up. Now, the supporting schedules. Once you understand how the statements connect, the next step is learning the 7 core schedules that drive the entire model. And here's the key, don't overcomplicate it. Start with the basics of each schedule, understand what it's for, how it connects, and what it drives. Don't worry about being fancy, get solid. Here are the 7 schedules every 3-statement model needs and what matters most in each one. Let's start with revenue. Revenue is the top of the model and everything flows from it. You need to understand, how does this company actually makes money? Is it unit-based, subscription, transactional? From there, focus on realistic drivers, volume, pricing, market size. Keep it simple but logical. Cost, and that includes OPEX. Cost comes in 2 buckets. Cost of goods sold, or COGS, which is tied directly to the revenue, and operating expenses, OPEX, and that's SG&A, R&D, overhead, and so many others. Understand what's variable versus fixed, what scales with revenue, what stays constant. Your gross margin and operating margin depends a lot on this. Get it wrong and your model will look like fantasy. Next, the working capital. This is the engine of the cash flow. Track how long it takes for the business to collect from customers, to pay suppliers, and to turn over inventory. In other words, how long it takes for the money to come back with the profit. This schedule helps you answer, are we getting paid fast enough to cover what we owe? It directly feeds into the cash flow from operations. Next, fixed assets, which includes capex and depreciation. Here you track long-term assets, equipment, property, infrastructure. You build logic for capital expenditures, money going out, depreciation, which are non-cash expense over time. Capex hits cash flow and the balance sheet, PP&E. Depreciation hits the income statement and reduces taxable income. It all ties together. Next, income taxes. There's a schedule just for it. Taxes can be ignored way too often, but they change everything. Your model should reflect actual tax expense, not just some flat percentage. Timing differences, deferred tax assets or liabilities if this is relevant. This schedule links directly to net income and ultimately the retained earnings. Then you're going to do the equity schedule. Equity tracks ownership changes and accumulated profit. These include common stock, retained earnings, share issuance, buyback. Dividends reduce both cash and retained earnings. This is how the model reflects real world value being returned to shareholders. Next, the debt schedule. The debt schedule tracks how much the company owes and how that changes over time. That includes opening balances, new borrowings, repayments, interest expenses. This ties into the 3 statements, and yes, this is where you usually run into circular logic. Interest affects income, income affects cash, and cash affects debt. If I had to learn modeling again, I would master these 7 schedules. Not the shortcuts, not the dashboards, just the logic, line by line. Because when your schedules are clean, your model is bulletproof. Now, the next step into your journey is to model different types of business, different business model. Let me just clear something up. A business model is how a company operates and makes money. A financial model is how you represent that into numbers. The business model comes first and it shapes everything about your financial model. And it's not just about how revenue comes in and how costs behave. The business model can affect every schedule you build, sometimes in subtle ways and sometimes due to regulation or industry norms. Let me give you a few examples. A SaaS company. In a SaaS company, revenue is recurring based on subscriptions. You model things like MRR, churn, lifetime value. Costs are often front loaded, like sales and onboarding, but the revenue spreads over time. Working capital is light, capex is minimum, but equity might get tricky due to stock-based compensation. Manufacturing. Revenue is usually volume-driven and seasonal. COGS must reflect materials, labor, overhead, tightly linked to production scale. You will model inventory flows, extended payment terms, capex, depreciation play a big role because of the physical assets involved. In banking or insurance, revenue might come from interest income and fees, but the logic changes. You might need to model regulatory capital, loan loss provisions, and complex funding structures. Cash flow presentation can vary by region or standard. These are advanced models. Real estate. Revenue might be from rent or asset sales. Depreciation and leverage are central. You're tracking property timelines, lease lengths, or loan tranches. The debt schedule needs care. Now, at this point, you don't need to go deep into all of those complexities. You're still solidifying the basics. And the best way to learn is to do that in a controlled environment. That's why I recommend working with case studies. They are built specifically for learners. Models that focus on clarity over complexity. Inside Tactic on Demand, we include several industry-focused case studies built for this exact reason. They're like lab conditions. They're clean number, clear drivers, focused lessons. You get to see how assumptions change across industries without drowning into real-world noise. Once you understand how to model a SaaS business, then a manufacturer, then service company, your pattern recognition improves fast. And that's what you're looking for. That's when you're ready to layer on complexity with confidence. Let's talk Excel. Not hotkeys, not pivot table, not fancy tricks. I want you to hear this clearly. You can build an entire three-statement model without using any advanced Excel. If you understand the financial logic and structure, the Excel part will follow. It's a tool, not the goal. Too many people think they need to master every function or shortcut before they start modeling. They don't. They just need to start. Here's what actually matters. Can you follow the logic? Can you build something clear and accurate that actually works? Because financial modeling isn't about showing off. It's about being bright, readable, and reliable. You don't need macros. You don't need array formulas. You don't need VBAs. Here's what you do need. Some if statements, minimum and maximum formulas, a solid lookup function, user preferred one, XLOOKUP or index match, it doesn't matter. Those will get you 90% of the way there. And let me say something that might go against what you've heard. Keyboard shortcuts are not that important, especially early on. Yes, they save time, but they save seconds. I'd rather be accurate and a little slower than fast and constantly fixing things. So speed comes later, accuracy comes first. If you focus on clarity, on clean formula, simple logic, and structured sheets, you will build better models than someone racing through with shortcuts but no structure. Also, a few small tools will go a long way. Name ranges might help you avoid some hard coded chaos. Basic form control can make your assumptions interactive. Conditional formats help you flag errors and highlight key results. But again, don't stress about having these from day one. As you build real models, you will learn exactly when and why to use them. Your Excel skills will grow with your modeling experience. So don't wait to become an Excel pro before you build. Start building. Start with a story. Let Excel catch up. Now it's time for the real company challenge, modeling from a 10K. So you've built a three-statement model, you've practiced with schedules, you've tried a few business types. Now it's time for the real test, modeling a real company using its actual 10K. This is where theory meets reality. You're not working with clean numbers anymore. There's no guided structure, no pre-baked assumptions. It's just you, a PDF, and a lot of digging. And that's exactly why this step matters. When you build a model from a real 10K, here's what happens. You learn to pull the financials correctly across income statement, balance sheet, and cash flow. You deal with the footnotes and fragmented disclosures. You make assumptions because the numbers are incomplete, unclear, or spread across 12 pages. You learn to cross-check, making sure your historical data reconciles, totals match, and the model balances. It's uncomfortable the first time, but it's also the moment things click. Because now you're not just filling out templates, you're building something from scratch. Here's how I would approach it. I would pick a relatively simple, stable company. You can go to SEC Edgar database or to any website investor relation, the company that you chose from. Download the latest 10K and extract the 3 years of historical data. Keep it focused. Don't try to build every schedule at once. Start with a three-statement model and get it flowing. Then layer on your assumptions and logic. Keep your checks active. Build slowly. Let the balance sheet guide you. If working through a real 10K step by step sounds like something you'd like to help with, I've been organizing a hands-on walkthrough in Synthetic On Demand. It's designed to help you actually build a working model from a public company 10K with structure, support, and feedback along the way. If you want in or just want to know when exactly the next cohort opens up, check the link below. You can register your interest there and I'll send you details as soon as we're live. Now, let's go back. Modeling a real company shows you where your understanding is solid and where it needs work. It trains you to deal with ambiguity, to interpret financials like an analyst, to think like a builder and not just a formula plugger. You make mistakes and that's the point. But once you finish your first real company model from scratch, you never look at financial statements the same way again. That's the moment you become a modeler. Next step, certification and skill validation. At this point, you've built models, you practice the logic, maybe you even tackled a real company from scratch. So what's next? For many people, the next step is certification, a way to validate your skills and stand out, especially if you're switching careers or don't come from a traditional finance background. The certification I personally recommend is the AFM by the Financial Modeling Institute. It's not the only one out there though. There are the FMVA, the Financial Modeling Evaluation Analyst from CFI, which is another widely recognized option. Both are focused on real-world financial modeling and both show employers that you can do more than just follow tutorials. You can actually build, analyze, and explain a model from scratch. Now, do you need a certification to get a job in finance? No, but it helps. A certification gives you a structured milestone to work toward, confidence that your skills hold up under exam pressure, something concrete you can point to in interviews. If you follow the steps in this roadmap and you feel like you're starting to really understand the flow and logic of a complete model, then certification might be a great next step. It's not about collecting credentials, it's about proving to yourself and others that you can do this. Finally, going to the advanced models. At this point, your foundation is built. You understand the three-statement model. You've practiced with different business types, maybe even model real company. You've built schedules, made assumptions, started thinking like a real analyst. So what comes next? Now you can start leveling up, moving into more advanced models like the discounted cash flow or DCF for valuation, levered buyout or the LBO models for private equity, mergers and acquisitions for strategic deals, scenario planning, sensitivity analysis, cap table modeling for startup or funding rounds. But here's the key: don't rush. Don't rush this part. Advanced models aren't hard because the math is complicated. They are hard because the logic stacks on everything you've already learned. You'll be tracking more assumptions, more moving parts, and more circular logic. And now the stakes are higher because these models often inform million-dollar decisions. So take your time. Start with simple DCFs. Get used to forecasting free cash flow and estimating a company's value. Then trying an LBO, see how leverage amplifies returns and risk. Then try modeling an acquisition. Layer in synergies, cost savings, goodwill. Each step deepens your understanding on how financial decisions show up in the model. And if you're truly serious about going pro, especially in investment banking, private equity, or corporate development, you might consider the CFM, the Chartered Financial Modeler certification from the Financial Modeling Institute. It's extremely challenging, but it's also a benchmark of mastery. If the AFM says, I know how to build, the CFM says, I can handle complexity at the highest level. Just remember, this is not a race. Your job is not to impress people with complexity, it's to build models that work once they are logical, reliable, and readable under pressure. So take this step when you're ready. Advanced financial model will be there waiting for you. If you have made this far, you now have a complete roadmap. You know how I would learn financial model if I had to start over from the three-statement model to advanced certifications. And here's the most important thing: you don't need to master it all today. Start where you are, pick one model, build it, break it, fix it. That's how you learn. Every time you solve a broken formula, every time the balance sheet finally balances, that's another layer of understanding you've earned. If you stick with it, even just a little bit every day, you'll be shocked at how far you can come in 6 months. If you found this roadmap helpful, do me a favor. Hit the like button, leave a comment, tell me which step you're tackling next, and if you want more videos like this, subscribe to the channel. Your support helps me keep creating real, practical content that actually moves your career forward. Thanks for watching, and I'll see you in the next one.